The next crisis is brewing. It's not just another recession. It's a fundamental shift that could reset the global financial system. Most people won't see it coming. Many will lose their savings, their investments, and their peace of mind, but you don't have to be one of them. Today, we'll uncover the truth about the dollar crisis 2025. Why does it matter? What's likely to happen? And most importantly, what you can do to protect yourself and your family. Welcome to the Passive Path. Let's get started. The US dollar became the world's reserve currency for a reason. After World War II, the US emerged as the world's strongest economy. Most other countries were devastated. They didn't have gold or stable currencies, so the US dollar was pegged to gold. Other currencies pegged themselves to the dollar. This gave the dollar a unique role. It became the currency used for global trade. Countries like India, Brazil, and Saudi Arabia used dollars to buy and sell goods. This system worked, but it had a hidden cost. To maintain this role, the US had to run trade deficits. It bought more from the world than it sold. This sent trillions of dollars overseas. Since 1980, the US has run $16 trillion in trade deficits. That's $16 trillion flowing out into the global economy. What did other countries do with those dollars? They reinvested them in US assets, treasury bonds, stocks, corporate bonds. This created a cycle. The US bought goods from the world. The world took those dollars and invested them back into the US. This kept US government borrowing costs low. It also boosted the stock market. On the surface, it seemed like a win-win. America got cheap goods. Other countries got a strong market for their products and a place to invest. But underneath, a bubble was growing. The US government borrowed more. The Federal Reserve printed more money. The national debt ballooned. In 2002, the US government owed $6 trillion. By 2025, that number has exploded to $36 trillion. Off-balance sheet liabilities, like Social Security and Medicare, push the total near $250 trillion. This growth wasn't sustainable, but the world kept going because the system kept the bubble inflated. Every time there was a crisis, the government and the Fed stepped in. In 2008, during the financial crash, in 2020, during the COVID pandemic, trillions were printed, trillions were borrowed, markets recovered, the bubble grew even larger. But there's a limit to how long this can continue, and now that limit is near. The passive path is all about seeing these patterns before they explode, and right now, the signs are clear. The same forces that led to past crises are back, but this time they're even bigger. Trade deficits have doubled since 2002. The Federal Reserve's balance sheet has grown more than tenfold. U.S. wealth has soared from $46 trillion to $169 trillion. But much of that wealth depends on low interest rates and constant money printing. China's economy has surged. Goods cheaper worldwide. This would force trading partners to buy more American products. This strategy was outlined in a document by Stephen Moran, a key economic advisor. It was called the Mar-a-Lago Accord, named after Trump's Florida resort. The goal was clear: protect American industries, punish China's economy, reduce the trade deficit. But every strategy has a reaction, and China viewed this plan as an act of war. China's leaders saw it as an existential threat. If they could not sell goods abroad, their economy could collapse. The survival of the Chinese Communist Party was at stake. China prepared to retaliate, hard, and in ways that would hurt the average American. The passive path teaches that global events always ripple down to personal finances. Trade wars are no exception. Higher tariffs mean higher prices for consumers. Everyday goods become more expensive. Shortages can develop, inflation rises. But the danger does not stop there. Foreign countries began dumping U.S. Treasury bonds. This pushed interest rates higher. As bond prices fell, borrowing costs for the U.S. government soared. To keep rates from spiraling out of control, the Federal Reserve had only one option: print money. Buy back the bonds. Flood the economy with dollars. This led to even more inflation. The value of the dollar started to fall. Since January alone, it has already dropped 10%. Experts warn it could fall another 30 to 40%. A falling dollar hurts everyone holding cash or dollar-denominated assets. Savings lose value, import prices rise, living costs surge. Meanwhile, gold and silver prices climb. So do the costs of essentials like food, fuel, and housing. The passive path community understands this cycle. When governments manipulate currencies and debt, average people pay the price. But there are ways to prepare and even profit. In the next section, we will break down how the coming dollar crisis could mirror the events of 2008 and how you can avoid the mistakes most people made back then. Like and subscribe to The Passive Path to stay one step ahead. In 2008, the global economy stood on the edge of collapse. Banks failed, credit froze, stock markets crashed, millions lost homes, jobs, and savings. The U.S. government responded with massive bailouts. The Federal Reserve printed trillions of dollars. Markets recovered, but the underlying problems were never solved. They were only delayed. The trade deficits continued to grow. Debt levels soared. Asset bubbles inflated again. By 2025, the numbers are staggering. The U.S. government debt has climbed from $6 trillion in 2002 to $36 trillion. Trade deficits have doubled. The Federal Reserve's balance sheet has grown from $700 billion to over $9 trillion. Wealth appears to have increased, but much of it depends on cheap credit and constant money printing. Now, the same pressures that triggered 2008 are back, but they are much larger. The dollar is losing value. Interest rates are rising. Trade assets, the consequences will be severe. Stock markets will fall. Bond prices will drop. Interest rates will spike. The Federal Reserve will respond by printing more money, just like it did in 2008 and 2020. But printing more dollars will only accelerate inflation. Higher inflation will erode the value of savings. It will increase the cost of living. It will widen the gap between the wealthy and everyone else. The passive path is about understanding these patterns and taking action before it's too late. Most people will wait for the government or the media to tell them what to do. By then, it will be too late. In the next section, we will reveal how inflation will reshape every part of your financial life, and why those who prepare now will have the biggest advantage. Like and subscribe to The Passive Path so you are ready for what comes next. Inflation is not just a rise in prices. It is a silent tax. It reduces the value of your money without changing the number in your bank account. When inflation rises, every dollar buys less. Groceries cost more. Rent and mortgages climb. Utilities and fuel become more expensive. Wages often fail to keep up. Even if your paycheck grows, it may not match the increase in living costs. Savings held in cash lose value. Retirement accounts struggle to maintain purchasing power. But there is another side to inflation. For some, it can be an opportunity. People with fixed-rate debt, like mortgages, can benefit. If you owe a fixed amount, but your income and the value of your assets rise with inflation, your debt becomes easier to pay. It shrinks in real terms. Imagine you owe $200,000 on a home. If inflation causes home prices and wages to double, your $200,000 debt stays the same while your income and property value increase. This is why many wealthy investors use debt as a tool during inflationary times. They borrow at low fixed rates. They invest in assets that rise with inflation: real estate, commodities, businesses with pricing power. Gold and silver often perform well during inflation. So can certain stocks, especially in sectors like energy, agriculture, and essential goods. Bitcoin and other digital assets may also serve as hedges, though they come with higher risk. The passive path encourages building a portfolio that can survive and grow in inflationary environments. Diversification is key. Holding only cash is dangerous. Spreading investments across assets that respond differently to inflation reduces risk. Your daily expenses will change too. Food prices may rise sharply. Housing costs can climb. Healthcare and education expenses often outpace general inflation. Planning for these increases is essential. Cut unnecessary spending now. Increase income streams if possible. Invest in skills that stay in demand regardless of economic cycles. Inflation reshapes everything, but it does not have to destroy your financial future. In the next section, we will focus on specific actions you can take now to prepare. Investment tactics for navigating a crisis economy. These strategies can help you protect and grow your wealth even in turbulent times. Like and subscribe to The Passive Path to continue building your financial resilience. Smart investing in a crisis economy requires clear thinking. Fear drives many people to make bad decisions. You must stay rational. Here is a simple plan for different time frames. Short term, expect market volatility. Stock prices may fall sharply. The dollar may weaken further. Some investors choose to short stocks or the dollar. This strategy carries risk and is not for everyone. Safer moves include holding assets that tend to perform well in uncertain times: gold and silver, commodities like oil and agricultural goods, stocks in sectors that provide essentials such as food, energy, and healthcare. Medium term, watch for signs of central bank action. When financial stress grows, the Federal Reserve is likely to cut interest rates. It may also start printing money again. This can lead to a rebound in asset prices. Stock markets may recover, real estate may stabilize, but inflation will continue rising. Position yourself for this shift. Be ready to move into quality stocks, real estate, and other assets when the rebound starts. Stay alert for opportunities in undervalued sectors. Long term, focus on building assets that produce income: rental properties, dividend-paying stocks, businesses that can thrive in any economy. Use debt wisely. Fixed-rate loans can become an advantage if inflation remains high. Your debt stays the same while your income and asset values grow. Do not try to time every market move. No one can predict exact market bottoms or tops. Stick to your long-term strategy. Keep learning. Study how past crises unfolded. Understand how policy decisions affect markets. Stay flexible and ready to adjust as conditions change. At The Passive Path, we believe wealth is built through preparation, patience, and smart action. This crisis will create winners and losers. Your choices will decide which group you join. In the next section, we will discuss the global risks beyond finance. These include geopolitical tensions that could reshape economies and societies. Like and subscribe to The Passive Path to keep strengthening your financial strategy. Financial crises rarely stay within financial markets. They spill over into politics, trade, and sometimes military conflict. Today's tensions are rising fast. The trade war between the United States and China is just one part. Currency wars have begun. Each side wants to devalue its currency to gain an advantage, but history shows this can escalate. Trade wars often lead to broader conflicts. The Boston Tea Party was a response to British trade taxes. It helped ignite the American Revolution. In the 1930s, trade barriers deepened the Great Depression. They also contributed to the rise of authoritarian regimes and eventually World War II. Now the same cycle is appearing again. Trade tensions and economic policies are mirroring past actions that led to significant global conflicts. Treasury bonds. Selling those bonds could spike U.S. interest rates. That would strain the U.S. China could also restrict exports to the U.S. This would create shortages of goods. It would raise prices and fuel more inflation. American businesses operating in China face risks too. Tesla, Apple, Starbucks, McDonald's, all could be forced to shut down their Chinese operations. Military risks are also growing. China could increase pressure on Taiwan. It could block trade routes. It might encourage North Korea to take aggressive actions. Any of these moves could trigger wider military responses. This would create global uncertainty. Markets would react with extreme volatility. Supply chains would break down. Critical goods could become scarce. Energy prices might surge. For investors and families, this means more than financial planning. It requires preparing for broader disruptions. Stay informed about global events. Diversify supply sources where possible. Consider the security of your income streams and physical assets. The passive path emphasizes readiness for both financial and geopolitical shifts. Crises are not just numbers on a screen. They affect real lives, real businesses, real communities. In the next section, we will focus on the common psychological mistakes people make during crises. Avoiding these errors can protect not only your wealth, but also your peace of mind. When crises hit, fear takes over. Fear leads to costly mistakes. Most people repeat the same errors in every downturn. Here are 5 traps to avoid. First, denial. Many ignore warning signs. They assume things will return to normal. By the time they act, it is often too late. Second, panic selling. Fear drives people to sell investments at the worst time. They lock in losses. They miss future recoveries. Third, chasing trends. Some jump into risky assets just because others are buying. They buy high and often sell low. Fourth, overconfidence. Others believe they can predict every market move. They take excessive risks. When they are wrong, the losses are severe. Fifth, paralysis. Some freeze and take no action. They watch their savings shrink without a plan. The passive path teaches a better approach. Recognize emotions, but do not let them control decisions. Stick to a well-thought-out strategy. Review and adjust that strategy as conditions change. Focus on what you can control: spending, saving, asset allocation, skill development. Stay flexible, but avoid impulsive moves. Remember, wealth is often transferred during crises. Those who stay calm and prepared gain assets at lower prices. Those who panic often sell those assets at a loss. In the final section, we will bring together the key actions you can take now. These steps can help you not only survive, but also build lasting wealth through the coming challenges. Like and subscribe to the Passive Path to stay ready while others react. You now understand the risks. You also know the opportunities. With someone you care about, help them prepare too. Good luck on your journey. Feel free to explore other videos on the Passive Path to deepen your knowledge, and I will see you in the next video.